Deep Dive with David Stendahl, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey there, it's David Stendahl with tonight's Deep Dive. It is January 16th, 2019. Lots of market I could select from, but I'm going to look at lean hogs just because I haven't looked at it in a little while. ETF HOGS, it's not the most liquid, but at least tradable. We've got a mixed bag here when it comes to the trends going on right now, and I often like to look at mixed trends and markets that have kind of a sideways consolidation with the technical rating, neither positive nor negative. And so there's a number of them that are actually out there right now. Now, there's nothing really popping up here, but when we look at the deep dive on the weekly basis, here's hogs down here, and there's a number of markets that we've got out here that are dealing with a lazy weak indicator, weak meaning W-E-E-K, not weak W-E-A-K, and what we have is a condition where the market has been going sideways, not really overbought or oversold at extreme levels for 11 weeks. And so if we actually pull up hogs, you can see the sideways consolidation here where we've had the market just basically moving sideways, going finding support at this level, this reaching all the way back through here, so it's been fairly strong at a 23, and then we have two resistance levels, a 33 and a 38. Those aren't the prices, that's just how strong the support and resistance levels actually are. We have a weak one that is being tested right now. It's just a 7, but it's still building out. But the point is that this little sideways consolidation can only go on for so long, especially on a weekly bar basis. Something big typically happens. So I'm going to give you a couple of numbers, at least since we're down at the support levels, that you should be watching here because these are going to be critical. We've got one at 60.25. That's what this level is right there. That's the weaker of the two. And this one over here at 59.68. This is the stronger of the two just because the strength is 23 versus the 7. Point being, we're down at support. We got two levels of support. We're breaking the first one, and there's a good chance that we'll break the second one here. If it does, that's good because we're short the market, having unwound some of our long positions today and added to our short positions. I'll show this to you here. So here's the liquidation of the longs. We just added another daily short system. If this is actually able to break through those support levels that I was just pointing out, then that's obviously good for our positions. Seasonally, not real strong seasonal bias right now, but we will see here shortly a bias to the upside, well, in picking up speed in March, but going into March and April. And then what we would see is just that trend. So on a short-term basis, just expect the trends to start to head higher. And the reason I'm pointing this market out is that the seasonal bias to the market is going to start to pick up, all while we're actually down at this lower support level. And so that's why this is kind of critical here, because does this mean that we're going to follow the traditional seasonal bias to the market, or is it really going to break down here and we could find ourselves falling to much lower levels? And because we're in this sideways weekly consolidation, there's a lot of pent-up energy that could really force this much lower. So I'm just pointing out that we're short, looking for hopefully a break below these particular levels. The seasonals are telling us something, a different story, and whenever we have one thing pointing one direction, another thing pointing another direction, usually means for some fireworks. So for those of you that trade hogs, and I would suggest to a lot of people that you actually do take a look at it because it's a good market to trade, especially from a systematic approach. In fact, I want to point this out that I grade all of the markets, and I do this on a frequent basis. Every quarter I go through a very elaborate process. It takes about 2+ weeks to generate these numbers, and what we do is we compare all of the different markets and give them a grade. And so with lean hogs, hogs. It's it's quote unquote an A market to trade from a systematic approach because of just the way that it likes to move. And cattle also is a good market, but hogs in particular just has a near zero correlation to a lot of other markets. So if ever you're looking to put a particular market into your portfolio, realizing it's not the most liquid, it's not the worst, but it's not the most liquid market, it's still a good market that you should probably incorporate into your trading portfolio and take a serious look at it. So bottom line is we're short the market with 3 positions here. We unwound these long positions, and I would suspect that if we break through that support level, then all is going to be good from our perspective on our trading side. But because the seasonals are going to start to pick up here, there could be some extra volatility. So watch your positions closely, and if ever you have an opportunity, definitely take a look at hogs because it's one of the better markets to trade. So thanks very much, and we will talk to you tomorrow. Bye-bye.